reminder that we love questions from the audience. So you can start commenting your questions now, or you can also add them as we go. I'll be right back on to welcome our guests to the show. For coffee. Watco Logistics makes supply chains simple. Whether it's rail, road, river, ocean, or intermodal, they manage your supply chain with efficiency and care. From heavy haul trucking to e-commerce fulfillment, they tailor solutions that fit your business, no matter the size or the complexity. Watco combines smart technology with real human insight to keep your cargo moving and your operations running smoothly. You can learn more about their full suite of services at watco.com/logistics. I just saw a comment that says they'd like an iced vanilla latte. Me too. I always show up to this without my favorite coffee beverage. So, you know what? Let's just kick this off with everyone commenting their go-to coffee order. I think that'd be a great way to wake us all up this morning. So I'm already hydrating. I already moved on to water. Got up a little early for the show today, but would love to know what y'all are drinking for your coffee today. If you grabbed a coffee or if you have a bad coffee habit, let me know what it is. But thank you all so much for joining us today. Really excited to be able to really have the privilege to host this amazing panel. This is something that we've now done, I think, 3 or 4 times. We focus on an end of year update and then a mid-year update. So the last time we had a panel was back in January, kind of kicking off what we thought we were going to be seeing for the first 6 months of this year. And now we're going to revisit that now that we are into Q3. Would love to see kind of where we stand and what we can be expecting for the next 6 months that we have ahead. Real quick, the next conference that we have coming up is JOC Inland Distribution Conference. If you guys have never been, such an amazing experience. I really recommend it. If you guys are involved in the rail, truck, any type of over-the-road transportation, drayage, inland ports, it's just such a valuable conference to be at. There's a lot of providers on the asset broker side. Lots of shippers are there as well. And I really love that they break everyone out into rooms. There's lots of breakout sessions. It's very collaborative. The major railroad representatives are there. I've learned a lot attending this show. So very excited to be heading back. We will have the podcast there, I believe, doing some on-site live shows. And so we're looking forward to that. But that is coming up sooner than we think. It's in September, which I was just thinking we're almost to the end of summer, guys. We're running out of summer already. And I hate that I just said that out loud, but we're already almost into August and we'll have back to school. And then we'll be right into conference season with September. So you guys can save some money with the discount code for JOC Inland that I put in the comments here on this podcast show. Okay, without any further ado, I would love to go ahead and bring on all of our guests today. We have more than usual, so I'm going to let them all introduce themselves. So good morning, everyone. Thank you for joining.
Good morning. Morning.
It's great to have you guys here today. I'm going to go ahead and let David, because he's sitting closest to me on my screen, start us off with some introductions.
Thanks, Samantha. Great to be here and surrounded by a group I consider to be, the best in the class at what we're talking about today. So, my name is David Spencer, Vice President of Market Intelligence at Arrive Logistics. I've been in transportation brokerage space for about 15 years now, really focused on data, pricing, strategic operations. Right now with market intelligence, focusing on what's going on in the freight market. How does that affect our business? How do we kind of shift what we're doing? How do we communicate that to the partners that we work with and advise how they navigate those conditions as well? So excited for the conversation today. Thank you. Yeah.
And David, what's your go-to coffee order?
Go-to coffee order. I'm like to the point, either like espresso on ice or iced Americano black. You just give me the coffee. Let's go.
Love it. All right, Chris, you're next on my screen.
Samantha, great to be on the panel again. Would definitely echo David's sentiments on the esteemed folks we kind of have around the screen here. Enjoyed the opportunity 6 months ago to kind of throw out some darts for 2025 and what a difference 2 quarters makes. It'll be fun to kind of go back down memory lane and revisit kind of what we thought was going to happen, what did happen, and where we think we go from here. So I'm Chris Pickett, Chief Commercial Officer at DAT Freight. We're pioneering shared truckload service at scale. So shared truckload is basically full truckload service, same truck, same driver, no terminal consolidation, but only pay for the space that your shipment needs. So if you have 13 pallets, half a truck, you no longer need to pay for a full truckload to get that freight moving. In addition to that, I'm an analyst at Pickett Research. I've been around since 2021. Write a monthly 45-page love letter to the freight industry, effectively throwing out one updated rate chart and spending 44 pages of a market narrative trying to support or contradict the implications of where the chart suggests we're headed next. So that's out there on a monthly basis. And prior to that, spent 14 years scaling up Coyote Logistics. During that time, kind of built out and published what became the Coyote Curve, which again, the idea of this kind of recurring market cycle, look to the past that could signal where we go from there. Since been rebranded as the Curve, I believe, since they've merged in with ARC. So arguably I've had a pretty unhealthy obsession with the U.S. freight market and the rate cycles for going on 15, 16 years now.
Awesome. Well, thanks so much for being here, Chris. Would you like to tell us what your secret coffee order is?
I'm a simple man. It's shot and a black coffee.
There you go.
I'm red eyes. I can't do the black eyes anymore, so I've geared down to red eyes. So I'm taking
next up on my screen, let's go to Jason.
Hi, everybody. Thanks again for having me back. Jason Miller, I'm the Eli Broad Professor of Supply Chain Management here at Michigan State University. Primarily an academic researcher, but provide a lot of economic commentary, especially as it pertains to the freight market. And just like Chris and David said, it'll be interesting to look back, what we were thinking 6 months ago versus how it's turned out. And I'll be very curious where we all see things heading the next 6 months.
Awesome. We'd like to know what a professor drinks for his coffee order.
So I am a coffee snob. So Nespresso Virtuo and the Ice Forte is my favorite.
Love it. Awesome. And Dean, thank you so much for joining us today. Would love to hear more about you.
Yeah, Dean Croak, market analyst here at DAT. Only been studying this market for 25 years, so not nearly as tenured as Chris and David and Jason. But my perspective is really from the carrier side of the industry. I do a lot of the external data analytics on what capacity looks like based on my extensive experience in trucking. Spent a few years at FreightWaves, so I've probably spent the last 10 years in freight market analytics, which has been really exciting. But in the 25 years I've been here, I haven't seen anything like what we're going through right now, where the word unprecedented pops up a lot, but I'm not sure that even adequately covers the level of uncertainty that we're all facing. I'm a latte with an extra shot guy, like pretty simple, filtered coffee. Nothing fancy.
Awesome. I love that. And you know what? I'm going to go ahead and give a quick introduction to myself because I never do that. And we might have some new listeners here today. So my name is Samantha Jones. Unlike these gentlemen, I have been in our industry for about 7 years now. What's been really interesting and fascinating to me is to learn more about what this industry looked like prior to the year 2020, because that has been the bulk of what I have experienced is 2020 and on. And so I know that there's a lot of other people in this industry who are also in the last 7, 8, 10 years have joined. And so I think it's important for us when we're trying to understand market cycles and even economics to be able to lean on data that is both past, present, and predictions for the future. And so I've always found that helpful throughout my short career in our industry. And so that's what prompted me to start the podcast a couple of years ago. And so I'm the host of this podcast. I am also the author of the monthly truckload market update, which this podcast helps to fuel. And I will be publishing that this week based on some of the inputs from our guests here today in this podcast. I own Samantha Jones Consulting, and I now do consulting for brokers, carriers, and technology companies in the domestic transportation space. And my expertise is in sales and brand growth. So I focus a lot on the revenue generation side of businesses. So I think that's all of our introductions for the day. I'm excited to jump in. We're going to try to keep this moving along quickly, but I want to remind everyone who's listening today. Well, first, I want to thank you for your coffee orders because I'm enjoying reading also. So if you're just jumping in, put in your go-to coffee order. And also, if you've been here, you're just jumping in, we'd love to have you guys just enter your questions. If you already brought questions, if you're thinking of something, put them in now. And we'll either, if we don't cover them in our conversations naturally, I'll make sure we get to those towards the end. But it also might help still steer conversation if we see some questions from the audience. So anytime you guys think of something, pop it into the comments. We'll see it. Okay, kicking us off, I had Jason and Chris on our January market update. And so the first question I always ask is kind of give us an overview, a high-level overview of the current state of the economy and the freight market as you guys see it today. And then I would love to know, in what ways does the current state surprise you, or is it as you expected it to be when we had this conversation back in January? So I'm going to go ahead and kick it off to Chris, and then I'll let Jason follow since they were on this panel, and then we'll let David and Dean jump in with any other comments too.
Yeah, I mean, I'd say at this moment in time, and we'll talk about kind of forward projections, a little bit further along in the conversation, but I would say the current state of the economy is unexpectedly strong. I think in terms of what we figured kind of coming into 2025, the freight market unexpectedly flat to neutral. I think when we were on the panel back in January, I was probably the most bullish box on the screen in terms of where freight rates are headed. And the reason was we kind of broken out of the kind of most extended 4-year kind of freight rate cycle that kind of kicked off going into COVID, went into the post-COVID correction in early 2022, spent 2 long years in purgatory, had just broken year-over-year inflationary kind of third quarter going into fourth quarter of 2024. And so based on the last 5 or 6 cycles, typically when that happens, it's a steady march up and to the right, certainly at an unpredictable, oftentimes slope and kind of how high you go, but it's poised to break higher. The macro indicators were all coming in pretty firm in terms of where consumption was, GDP, relative inventory levels. I think the one strange bird was industrial production. Mm-hmm. And then coming through kind of really the last 5 or 6 quarters, U.S. industrial production was effectively flat year over year, despite strong to accelerating U.S. consumption, which is something that doesn't really happen for very long. So I think the prediction coming into 2025 was, I think the consumer's still going to hang in there, despite the raft of headwinds that have only accumulated since then. Consumers will consume, consumption stays solid, GDP hangs in there, there's no recession, and eventually, industrial production will have to come up to meet consumption as inventory burns off and things get back to normal economic conditions. All that was happening kind of really through end of January. I think from a macro standpoint, the consumption numbers came in remarkably strong, at least the preliminaries in Q1, although they adjusted down with forward revisions. Industrial production did start to kind of surge up. Again, surge is a relative term, plus 1 to 1.5%. All that looked great. Then all of a sudden, the trade wars start, shots are fired kind of end of February with the first couple of executive orders, and things turned right over. I think consumption mostly hung in there, but definitely softened. And certainly market rates, we started kind of Q1 with the U.S. spot truckload index starting up at plus 12.5% versus a forecast of, I think, 15, like the first 3 weeks of January. And then from there, it skidded steadily lower. And again, how much of that is supply versus demand effects? We can kind of debate that, but certainly, as those executive orders started coming in, the additional 10% on China, 25% on Canada and Mexico, and things have shifted dramatically since then. I think you have seen consumers pull back, and I think you've seen kind of producers and supply chains effectively stall out and cease from making any material kind of investments, stall hiring until we get more kind of forward visibility on total landed cost, and arguably that hasn't changed. So I think the economy is hung in as expected. Freight market, not so much.
Yeah, I think tariffs were like on the bingo card in January, but to this extent, I think we underestimated for sure how crazy things would get. So love those call outs.
No, I would echo a lot of what Chris said. So, I mean, I was fairly bullish as well. So I wrote a December piece in Supply Chain Management Review where I was quite bullish on where things would be in 2025 because we had a lot of tailwinds at the time. It felt we had just hit 100 basis points of interest rate cuts. So everybody was expecting the housing market, not only existing sales, but more importantly, those new starts that generate so much freight to really be rocking and rolling. And those were down 7% year over year in May. If somebody would have said to me, housing starts in 25 are going to be less than 24, I would have laughed at them 6 months ago and said, that's just not possible. And so when you look at it, we had a tight market in January up till MLK Day. February is February. Like February is always weak. And then I think where most of us were at was we expected March we would start to see tightening as a lot of the industrial economy and housing starts coming back up. And then it would start progressively tightening throughout the year. June would be really tight. July always loosens up. It's auto plant shut down. We're past beverage season. Produce season's waning. But then we would tighten up in the fall. And instead, basically, what we have right now is a repeat of 2024 from a pricing side. Like if you look at line haul spot rates, you look at spot rates with fuel, they're literally now flat for the last 2 years, basically, with little seasonal spikes. I was just looking at DAT spot rates this morning because I always like to look at what happens in July. Like 3 days ago, they were $2.11 a mile. Mm-hmm. Then they were $2.09 yesterday. They'll update today, puts it at $2.07. And so that's just telling me it's already heading back and we're basically where we were again in 2024. And as Chris mentioned, this is really 100% due to the tariffs and the tariff uncertainty, because you can see this in the comments from the Institute for Supply Management's manufacturing surveys, the Dallas Fed Manufacturing Survey, the Kansas City Fed Manufacturing Survey, is we were on a very nice upward movement for new order momentum in December and January, and that's fallen off of a cliff right now. And what scares me the most is you now have a lot of the reciprocal rates, which caused the market, remember, to melt down in April. They're basically kicking back in here in August, it appears. And there's just one real wild card out there, and we don't know what's going to happen with the EU. And so, kind of get it, we're not, the market is not in a healthy place right now. Certainly compared to where I thought it would be. Like I look back in December and I'm like, oh, I thought that spot rates would be up 20% year over year by, by the Q4 of 2025. I'm like, oh, that's not heading towards a good trajectory at the moment.
Right. I'm going to go next to Dean because Ken from DAT was on our show in January. So Dean, I won't make you answer to everything that he said because sometimes it's a lot, but no, I'm just kidding. I would love to give you the opportunity to kind of share your thoughts on this too.
Yeah, we definitely thought that we'd be seeing some improvement seasonally, especially in the spring this year, but of course that didn't happen. One of the things we were thinking was that we would see a replication of 2024, even 2023 to a degree. So Jason mentioned that our rates are within a penny a mile of both those years, nationally on the 7-day rolling average. My prediction on our IQ show was that rates would be fairly flat this year in the spot market. I didn't see a lot of growth, largely because and this wasn't from a demand perspective, it was more from a capacity perspective. I didn't see any change in capacity because carriers don't need to go anywhere. They're not under any financial pressure to leave the market where rates are at the moment right now because of the tailwinds diesel prices have been able to give them. So I just, my take on the market at the start of the year was that we would see fairly flat rates. The market was close to equilibrium. And what we were seeing was every time there was a surge in volume, capacity would jump back into the market and flatten out spot rates. And I think we just saw that. Jason mentioned it. We saw it last week with 7.4. Always see a spike driven by produce season. We saw it with road check week. We'll see it again with brake check week in August. Rates go up and they come back down. Kind of tells us the market's at equilibrium. So that sort of was our take. And I think that's panning out, that rates will be end the year pretty much where they started.
Thank you, Dean. David, I'll let you wrap up this first little segment here. But what do you think as a high-level overview of just current state of economy and freight market?
Yeah, I mean, not a ton to add. These guys covered a lot. I think a few things of note. Pricing this year is the same as Jason mentioned, but this year is definitely not the same, right? I think a lot of the reason why we're seeing pricing in the same place, Dean, I think can probably speak to it, but how much lower can rates really go to sustain capacity, right? And so I think that's something that I think is really interesting, how long we've been in sort of this depressed rate environment. More than 3 years now where we've seen the deflationary conditions really going strong. So I think coming into the year, that was what we were all looking at. We were looking at increased seasonal response to demand surges as a good indicator of, hey, capacity is coming back into balance or more in balance than it had been. And I think that was a reason why a lot of us were optimistic about inflationary conditions this year for rates, right? But I think you can't speak enough to the impact tariffs have had, but I think it's also made things really difficult to get a handle on, right? If you look at the volatility of the way shippers have moved volume this year, whether that's pull forward, stopping and starting, you look at warehousing is jammed up a bit. You're looking at the free trade zone type situations that shippers are utilizing this year, right? So a lot of pull forward in inventory. To what degree is demand weakness or underperformance to seasonality this year slowing demand, or is it a result of pull forward? I think, it takes time for that data to really come out and come through. So we're still getting a good feel for what's driving these conditions, but certainly, that stability year over year is something we're seeing as well.
Awesome. Thank you, guys. And David, I'm going to let you kick off the next, because going last on at the end of 4 experts is a difficult one. I also want to thank Chad, Michael, and Steve. They put some great questions in. I have them starred, which means I hopefully cannot lose track of those. So we're going to get to questions towards the end of the show. But anyone else listening, please continue to add questions. We're not ignoring them. We're just waiting to get to them. But they're all starred. We will get there towards the end of the show. Okay, my second question, I'm going to go ahead and let David kick us off here. David, I would like to know, let's start and dig in a little bit more with the broader economy. So we'll put aside kind of freight market specifics here for a second, talk about the economy and what we think we're going to be expecting for the next 6 months. Kind of what data points are you looking most closely at or keeping an eye on as we move through Q3 and Q4?
Yeah, I mean, certainly there's a lot of discussion around what's going on with the consumer and inflation, the ability for the consumer to continue to spend at the levels they had been spending and really drive goods consumption, which drives freight demand, right? So in addition to that, you look at, it's been mentioned several times today, contraction in manufacturing. So, recent data did show a little bit of an uptick in production in the goods, the freight heavy components there, but new orders were down still, right? So a little bit of a mixed bag around manufacturing. I think we'll look to see what manufacturing does, big drivers of freight there. Like I said, the consumer and their ability to maintain spending is something that definitely is something to watch. So CPI, inflation, how far will the dollar go compared to what it did to where it has been? I'll let some of the economists here speak to more of the economic data and what we expect for the rest of the year. But what drives freight is really what we're watching, as it pertains to the economy. I think consumer spending power and industrial production manufacturing are the big ones.
Yeah, absolutely. Thank you for that. I'll let whoever wants to jump in next jump in.
You know, for me right now, one is I'm waiting to see the second half of the year. We don't know. Sort of the couple big questions are, one, the EU trade situation. I cannot stress enough how big of a trading partner the European Union is with the United States and vice versa. It is collectively our largest export destination, and it is collectively our largest import destination when you combine them all together. So we've got to see where that plays out, because if that goes into a full trade war, that's even more negative news for freight demand.
What is the biggest update, Jason, on timeline for that? Is there one?
Supposedly tomorrow's the day that they have to maybe say something. Then we've got, again, August 1 type of situation taking place. So, so watching that, watching what happens with USMCA, you know, because just seeing how this all plays out. Part of the discussion, of course, is right now, my understanding is with finished vehicles, is tariffs are being applied to the non-USMCA compliant finished vehicles, but eventually the goal is to tariff everything, but subtracting out the US value added from that. Customs just hasn't figured out how to implement that. So that's an additional tax. And then, you know, seeing if the Fed cuts rates here in July, I don't see that happening. And then I think we'll get sort of the picture for the back half of the year. But I'm kind of with Dean on this. I just think we're going to basically repeat 2024 at this point, because historically, and this is where, you know, I've always felt like I get on a bit of a lonely island, is I'm a firm believer in demand side dynamics are what drive bullish pricing cycles. It's all about the demand. Folks get obsessed over supply side, but like English language proficiency, that's not going to change anything substantially, right? When I hear figures, people saying 15% of drivers are non-compliant, like, come on, that's just a nonsense made up number. There's no way that could feasibly be possible. And so you look, what could drive demand in the second half of this year? You've got no containerized import surge coming. If anything, that's going to be down. Manufacturing activity in general is not doing great. Oil prices are so low. Fracking rig counts have been declining, so you don't have fracking coming to the rescue. The single family housing start market's already past peak building season, so we've missed that. And so you then have, what is consumers going to do with auto spending? Because there's good reason to believe a lot of auto demand got pulled forward in the first half of the year. What does that mean for the second half of the year? You mentioned, Samantha, the tax credits for like new appliances going away. That's a big one right there, because you start having weak single family housing and no tax credit for more efficient appliances. That's not a demand generator. And so you start looking at everything, and it's very difficult for me to point to sectors that are going to generate a lot of freight for carriers, because anything associated with the AI data center build out, yes, that helps certain construction oriented, you know, carriers, but warehousing construction is down at the same time. So there's a counterbalance on that front. Aerospace doing very well. Tariffs really aren't going to slow Boeing down, but that doesn't generate much freight. And so when you start looking at the freight-centric sectors, there aren't that many good things to see. And, you know, we were talking about it before the start. You've got a major bankruptcy in Del Monte Foods. I mean, they are a very large shipper. Canned foods are super heavy and disproportionately contribute to freight volume. What happens there? And so it's just, to me right now, difficult to get excited. Capacity seems to be moving sideways. If demand, my ton-mile index has it up year over year by 1.5%, which is okay, but it's not great. That's probably going to start tipping back towards neutral. And if capacity doesn't change, it's just more of the same at this point.
Real quick, we were talking before the show about the fact that the One Big Beautiful Bill Act passed. And so, just to put that as a note in here, I don't think it has too much relevance to today's conversation, but it does obviously extend some tax credit for consumers. There's an increased child tax credit for a good percentage of American families. So there might be no tax on tips, certain amounts of overtime and tips. So we could potentially see maybe some impacts of that helping at the end of the year, but I don't know how much that's going to help us obviously this year because those credits won't come until the spring of next. But on his point about the appliances, we are ending after this year the tax credit you get if you upgrade your appliances to more energy efficient appliances. That's poor timing because you have until the end of the year, I believe, to do that, but it coincides with one of the hardest hit consumer goods segments by tariffs thus far, which is appliances. So you can maybe get a tax credit if you upgrade, but they're now more expensive than they have been in years prior. So just kind of some poor timing there, I would say. I'll go ahead and let Chris or Dean jump in here.
I mean, I guess jump over a couple of comments, but I mean, I definitely agree with Jason, David around me. I think it's the kind of the consumer that's going to continue to drive the bus here. And that's going to be a function of kind of what happens with tariff driven inflation, consumers hang in, or not, you start to see some compression there. I would also not necessarily from a freight rate standpoint, I mean, I still think there's a case for, spot market line haul rates being up, not the 30 to 40% that I was projecting, back in January, but certainly I think there's a case for 10 to 15, unless the economy goes into a full blown recession. If this kind of the fog clears to some degree, businesses can make more kind of long-term decisions as more of these, trade agreements get, permanent, whatever the hell that means, right? These days where it's, does China stay where it's at really? Is Vietnam staying firm? Where are we with Canada and Mexico? And as that becomes more firm, do you start to see supply chains redeploying capital? And you start to see any version of recalibration taking place, right? So as total landed cost changes, certainly entire supply chains aren't likely relocating back to the US, but do you see businesses making different sourcing decisions where you might take 30% of your imports that made more sense to import from China or Southeast Asia and divert some of that to the US now? Not full on, but do you start to see some of those lanes changing? Do you start to see that creating a bit of an asymmetric tailwind for US manufacturing? And you start to see network shifting. And you kind of see this during disruption events where big storm comes in and suddenly contractor lanes go away because lanes networks change. You have a full splash of freight into the spot market. As more of these global supply chains do take some level of recalibration, do you see higher volume predictable contract import lanes suddenly becoming mini bids as some of that freight gets kind of resourced out in the market as things change. So if you see some of that take place, you could see you get a bit of an asymmetric kind of tailwind relative to the level of consumption that could have a marginal impact on freight market. I'm not basing a forecast on that, right? Because that's kind of a derivative of three chains of what ifs. But then on the supply side, I think there is something to the spot market being arguably unprofitable for the last 6 or 7 quarters. The latest kind of ATRA survey data, I think, had marginal cost of truckload transportation up 26%, 24 versus 2000. While all in spot rates were down like 15%. And arguably, certainly a lot happened in those 4 years, but at some point that math just doesn't math. And I think you are seeing just these more anecdotal cases of larger carriers, 100 truck plus fleets that have been on the record saying, look, we haven't made money since 2022. Mm-hmm. And as we watched the Samantha Jones Meet for Coffee podcast back in January, had high hopes for kind of where the market was headed. But now with this trade war, a lot of that optimism has dimmed. And you'll see, I think, more of those folks, unfortunately, having no choice but either permanently or temporarily idle those fleets. So I think as that comes together, again, I don't think we're seeing rocket ship plus 40% anymore. But I also don't think that there's a case for rates going much lower. So we're either kind of skidding at the bottom here, or there's some case for a slow melt up to say a 10, 12% inflationary scenario.
Dean, I think he teed you up perfectly there.
Yeah, it's a great point. It's a great point. I had a look at a cohort of 20,000 carriers. Average fleet size is about 244 trucks. They'd lost 14 cents a mile last year. So it kind of speaks to the pain that sector of the industry that represents about 80% of trucks on the road.
Yes.
That the pain they were going through. They have much bigger overheads than, say, the owner-operator smaller fleet. But they've been through a couple of years of pretty, tough times. I think the only thing that's been helping a lot of carriers is declining diesel prices. Even though they've been up 24 cents a gallon in the last month, they're kind of up, I think, a penny this week. That's been a little bit of a tailwind for the smaller operator. I think the bigger the fleet, the larger the exposure to crushing margins. because we're still seeing new rate development in our, if you think about our contract rates in DAT's world, it's about 50 billion in freight spend. New rates based on recent RFPs are still coming in plus or minus, maybe plus 0.5%, down 0.5%, and they've been like that for the last year. So, so contract rates aren't going up, but they're not going down either. They're kind of treading water. More alarmingly, though, dry van spot rates just flipped negative year over year in June. So after 10 months of being marginally positive year over year, they've now flipped negative. And as Ken would have told you on the last show, when we see rates flip negative year over year, that kind of signals the start of another recessionary freight cycle. Whether that is maintained because we've got the last week of July to pump up some of our rates, going forward, it doesn't bode well for the direction of rates for large carriers that are looking for some sort of revenue gain, especially on the back of what I would call a disastrous second quarter from a profitability perspective.
Okay. Well, we're all freight experts here. So when I ask about economics, we always inevitably shift into freight market conversations as well. So I took some notes on some things I want to revisit from each of you. I'm going to go back to the beginning real quick. David, would you mind covering in a little bit more detail interest rate cuts? Like we kind of had a little bit of conversation pre-show about this, but I feel like there's been a lot of emphasis on the need for interest rate cuts to try to help stimulate some economic activity. What do you think is currently the reason for interest rates being held where they're at?
Yeah, I mean, I think some of the data hasn't really supported the cuts just yet. I think, if you're out there and you're seeing and you're feeling it, that's one thing. I think that's why there's a big call for interest rate cuts. Out there, you've seen housing slow down, right, to a real crawl. I think in general, we're looking at interest rate cuts as an opportunity to see continued investment and continue to spark the economy in some way, shape, or form. So I think there's excitement and interest in that. I think there's conflicting views on is it time or is it not? The Fed, we know, typically gets this. Is lags when they should make those decisions a little bit, mainly because of the data that they're basing their decisions on. But I do think interest rate cuts are important, but it's really the cumulative effect of cuts over time, that really make a difference as opposed to, hey, here's a quarter point or half a point cut. You're not going to see that translate immediately and into an impact, on the freight economy. But, just to kind of respond, if I may, to some of the comments from the others after I got a chance to speak. I think, I do think we really should be paying close attention to what's going on the supply side, because while I don't think English language proficiency is going to be a big impact, I think the investigation around non-domiciled CDLs is something we need to be watching really closely as to what impact that could have. It's a big wild card. You don't know how sweeping of changes they're gonna come back with and say, hey, are we going to invalidate all these CDLs? That's something that I haven't seen is off the table. So situations like that, we're continuing to see some of the other freight economic data I think is relevant. Equipment orders are down and trending below replacement for several months in a row. These are the things that I think point to some challenges for capacity to keep up. I think supply side is declining. And if we do see whether it's interest rate cuts or some other form of stimulus to spark the economy on the demand side, that's going to expose capacity that's been attrited.
Thank you, David. Let's see, Jason, a couple people have mentioned real estate. I haven't covered that very well in recent podcasts or my newsletter, but do you have any numbers? Because it wasn't just like not great. It was pretty bad, like residential. I thought we were down pretty significantly. Do you have any better numbers on that?
Yeah, so if we kind of take a look, thinking about it, new single family starts are down about 7.5% year over year. And existing single family home sales, I got to look up that figure right now. But if we take a look, they're way, way, way down from before where they were even before COVID. And then especially when we take a look, let's say back in the back half of 2020, first half of 21,
Yeah.
So ballparking it right now, there's somewhere in the tune of about 4 million-ish units a year right now, give or take. Before COVID, they would have been steadily around, call it 5.4 million units a year. And then on the other side of COVID, they were hovering over 6 million units. And so when you combine just persistent flat movement of existing single family sales and then new housing starts being down, that even though existing sales don't generate as much freight as a new single family start, it still generates a lot. People get new appliances, new furniture, all of these things. And that's just it's not happening right now. Prices are so high. And with the 30-year interest rate as high as it is, or 30-year mortgage rate as high as it is, which is due to the 10-year treasury being as high as it is, we basically seem to be cutting the cycle. Even importantly, even if the Fed lowers interest rates, the 10-year and interest rates are not mathematically linked. The 10-year is more an expectation of where participants think inflation will be. And so until market participants really believe that inflation is not going to happen, it's unlikely that we're going to see that 30-year mortgage rate come down.
Yeah. Thank you. I think that is significant, 7% down from last year. Obviously, last year wasn't very impressive compared to previous years. So I think that was a notable, data point to call out. It can, given how much new just housing activity and moving drives freight volumes. Let's see. Good thing I wrote down notes because I'm already forgetting what I wrote down. Chris, you threw out the word recession odds, but that's I wanted to know a little bit more about that. You said, if in the scenario we enter a recession or there's some recession odds, since January when we last talked, we saw all sorts of adjustments to recessionary odds by all of the major sources. And so in your opinion, what do you think would have to happen for us to enter a recession either this year or towards the beginning of next year?
I think it's hard to envision a scenario when that happens this year. I think going into early next year, it's a pretty, significant drop off in consumption across most kind of goods categories. You're not going to look at the trailing, 25 or 30 years and maybe, less scientific, but, for the last, 6 or 7 recessions, there was a period of time called 2 to 3 to 4 quarters where, the direction of consumption slowed down. It wasn't deflation, but it was slowing down, well before we, landed in, the front end of a, NBER designated recession. And so the last few quarters going through kind of the post-COVID correction, you look at the direction of that consumption line is kind of one of the first things I look at, where until it bends lower, you can't start that clock for 2 to 3 quarters before you expect a recession. And it hasn't bended lower yet. I think that's been the big surprise for me the last couple of quarters, where you had the big surge during the COVID years where we went out and kind of bought everything, at least all the goods, because we couldn't consume services. Helicopter money, fanning those flames. As that corrected lower, we didn't plunge into a consumer recession. It kind of, bottomed out at, call it, 2 to 2.3%. It's since kind of returned course to, high 2s up to kind of plus 3.1%. So I think looking at that, just kind of where that's pointed going into at some point a rate reduction, phase, whether that's, September or a month or two later, it's hard to envision a scenario where even if that inflation kind of really starts to bite, that you see that much of a pullback. And so, especially given all the kind of the headwinds that consumers have, withstood even the last, couple of years, whether it's runaway inflation, high interest rates, resumption of student loan payments. I think everyone's predicting it fall off the consumer for the last, 2 years, and it hasn't happened yet. So my sense is that, again, the current administration, I think will thread some version of a needle here, and we'll see how it plays out, where, I think there's a reason we waited till, now to announce the next kind of, shots fired, where, equity markets are at an all-time high. Labor markets are still strong, even if the last kind of print was somewhat skewed by, strength in, government employment. And so, I don't think the administration has any intent of, plunging the U.S. into a recession. I think we'll thread some version of a needle. So, I'm overall still pretty bullish on the U.S. consumer and kind of where this goes. Yeah. But, that remains to be seen.
Awesome. Thank you for that. Dean, I had a couple of thoughts for you, actually, and one just got put in the comments. One, David also brought up, but I was going to ask you on the carrier side. I know that used equipment has been is very affordable right now, and actually trailer orders and truck orders are down for new equipment. So even prices there have been falling. So, to what extent does that provide to fleets, or is it actually maybe a downside if they had equipment that they were needing to sell off to get any type of cash? I don't know if that's a positive or a negative there. And then my other question for you is weather. So I saw that the whoever puts out the name storms predictions, National Weather Service or something, has said there's going to be 13 to 19 predicted named storms this hurricane season. And then someone just asked if there was any thoughts on the effect of defunding NOAA or FEMA on either the upcoming hurricane season or moving into next year. So what are your thoughts on used equipment and hurricanes?
Yeah, used equipment's an interesting one. We've certainly got there had been some demand for low mileage used equipment with the 2027 pre-buy that now has sort of dissipated somewhat. That led to a higher percentage of freight moving in private fleets and less on for hire truckloads. So that's sort of one of the contributing factors. According to ACT Research, that's gone away now in terms of the pre-buy emphasis on buying pre-2027 trucks. So I still see strong demand for smaller operators, owner-operators looking to trade up to a low mileage used truck with a little bit of warranty left in it. So I think there's still some upward price pressure on that side of the market. We're still seeing people want to get into this industry, which if you'd asked me in January, I'd have said, you're nuts. Like, what are you looking at? People are still wanting to join this industry, which is kind of baffling. But we're in strange times. We're, for the first time, we're in it's sort of a really bifurcated industry when you talk about where carriers are at. I think someone mentioned here floor price, where rates are at. I think Chris might have mentioned that. We're certainly there, but for the first time ever, I've seen a cohort of carriers that can run for $1.50 a mile today and still make $60,000 a year. And on the more profitable end, if they've been smart and paid off their equipment during the pandemic, and they run for $1.50 a mile and they haul freight in our Midwest bellwether states, our 13 states in the Midwest where the rates are averaging $1.92, and they've got a DAT 1 fuel card, they're making the equivalent of $42,000 a year, which is better than 2018.
Dean,
So
I like to think of housing. Like, I bought my house in early 21 on a very low interest rate, and 2 years later it was worth $100,000 more than what I purchased it for. I like to think of all the carriers who made decisions when financing was very attractive, when equipment prices were down, on a lot of different things, on even maybe their insurance policies or things. So like my home insurance was very, very cheap. And while I have taken increases when I went ahead and quoted market, everything was significantly above what I have already had locked in. Yeah. So I like to kind of think of like my home situation as where a lot of carriers might be finding themselves right now, where to get out of this home would be a disadvantage ultimately. And so their equipment and their contracts and their agreements that they put in place at the right time has become an advantage to them in the market. It
has. I mean, that has the end of the runway comes fairly soon with that aged equipment, because you start to get into engine reframe rebuild, in-frame rebuild time. So how long those trucks last is the bigger question, because they're not all, old-fashioned Caterpillar engines that'll last forever. These are emission heavy engines that have a much shorter shelf life. But I think the thing is that, and David would see this on his bid strategy, there's a whole lot of carriers out there that can operate much lower than the average. But there's also some carriers out there that need to run the wheels off their trucks because they've got higher repayments, and the bank is extending the credit terms to them to allow them to keep going, because on the other side, the truck's worth hardly anything compared to how it was financed. So I think we're in very interesting times. I do think, though, that the majority of carriers on the higher end of the operating cost have left the industry. And what we're left with is a cohort of carriers that are profitable. In the main, they're breaking even, getting by, paying the bills. They're not making substantial profits, but it's sort of, and I wanted to back that up by saying that when I said at the start of the show, carriers don't need to go anywhere. This idea that carriers have to exit the industry for financial reasons, it just doesn't exist at the moment. It doesn't make sense economically, short of some sort of a geopolitical catastrophe where diesel prices hit $5.80 over the summer again. That would be one thing that might cause a supply side inflection point in the industry. But the likelihood of that, given how diesel prices have behaved in the last couple of years, seems fairly remote.
No, and the various data sources back up exactly what Dean's saying. So if you look at the establishment counts, which are administrative records from the quarterly census of employment and wages, well, the number of trucking establishments, so physical locations with at least one employee, they're down a little bit in 2024 for the preliminary data we have from 2023. but they didn't collapse. And just as Dean mentioned, the real story is capacity today is very similar to what it was in 2019, maybe a little bit more because there is a little bit more non-employer firm capacity out there. That's your for-hire owner-operators and the like. But it's not that much dissimilar. Freight volumes are kind of where they were at in 2019. But what happened is we reallocated that capacity to a much larger number of small, young carriers that are out there. And that has changed the market dynamic a little bit. So rather than the industry becoming more concentrated, it's actually now more diffuse with a much bigger long tail, which is why brokerage is doing so well. But a lot of those small young carriers, they have fairly low cost structures unless they did very dumb things like buying equipment at incredibly inflated prices in 2022. And as Dean mentioned, most of those folks are gone. But a lot of folks use 21, 22 that paid off their equipment. And as long as there's not any type of catastrophic failure, they're good to go.
Yeah.
Which kind of brings us back to also maybe weather. And I think that kind of, you know what, I'm going to let the weather lead us into the rate, a specific rate question. But I also want to take a second real quick and just say, depending on what your interests are, what you guys pay attention to, or how much you pay attention to your IRAs or your investment accounts, I think it's very interesting to note that the stock market has been smashing records this year. And so I think it's just a fun contrast to me to say we can be kind of doom and gloom about freight markets and even some economic indicators. But if any of you find yourselves heavily involved in stocks and you're like, what are you talking about? Things are pretty great. It has been really interesting. And a few podcasts ago, I had Phil Rosen on, who does the Opening Bell Daily and talks a lot about markets. And so you guys might find that podcast episode interesting. But I did also have a note that I read recently that a lot of these stock market hopes are being propped up by hopes for rate cuts more so than tariff uncertainty. So they're willing to almost discount tariff uncertainty if we can get some rate cuts. But tariff uncertainty seems to be almost exclusively driving the lack of rate cuts right now. So I find that topic interesting, but we're not going to get too far into that. Before we move into my last question, well, we actually have two more questions, but we're going to have to be kind of quick here because we're getting close to time. I do want to take a moment to thank our show sponsor, Watco Logistics. It does actually take quite a bit of work to do a podcast, and so I'm very grateful to have a sponsor behind me to be able to do that. My producer, Aaron's been sitting backstage this whole time. I also have an editor, William, who helps Aaron with a lot of the post-show work. And so thank you very much to Watco Logistics for allowing me to be able to fund this and make this show possible. We've talked a little bit about tariffs and trade, and so something I wanted to mention that it made me think of is Watco's cross-border solutions. And so their cross-border can provide a lot of different options. They work with customers to find conversion opportunities from truck to intermodal or even direct rail car. And the benefits include inland clearance, no waiting at the border, better security, faster transit, and cost-competitive economics. So if you guys are interested in learning more about Watco Logistics, they're fantastic over there. Several of them were in the comments here today. I saw Chase and Ben listening in, I think. Fantastic gentlemen. You guys could reach out to them, or you could reach out to myself, and they would love to help you navigate parts of your supply chain, but also what's now become one of our nation's largest trading partners in Mexico with all of the shakeup that's been going on the last few years. Okay. Second to last question. Let's try to be quick here. Rates. We've all talked a little bit about rates to this point. So I think let's be succinct and say, if we had to just kind of peg a prediction like we did back in January, from July through the end of the year, what is kind of our concise takeaway on where we see rates headed? And I'm going to just start with David and work around our screen.
Cool. Well, I'll take that handoff and stick with, I think we're going to see rates kind of move along at flat year over year. Here as we get into the early part of next year. I mean, obviously pending any kind of wild card, right, from this administration or change, which is certainly possible. Or like I mentioned before, wild card as it pertains to these non-domiciled CDLs or some aspect that could affect capacity in the marketplace. So I think we're going to see stability for a while. Short-lived volatility is certainly on the table, as Chris mentioned, whether that's tariff on again, off again environments, or you see these little bouts of seasonal demand, right? But outside of those short-lived periods of volatility, I think overall we're talking about mostly stable conditions on a year-over-year basis.
Thanks, David. Chris?
I think I made the point earlier. I'm sticking to it. Yeah, I think all those headwinds are in play, no doubt. But I still think there's a case based on a combination of supply side and demand side effects of spot line haul rates still floating up to kind of a plus 10 to 15% year-over-year range, maybe about a 12 to 13% move from here. It certainly won't be linear, right, by any means. And maybe that's helped along by a storm or two or something unpredictable in terms of geopolitical risk or something that improves diesel. And then contract line haul fading kind of behind it, but more of a kind of a plus 3 to 4%. So I think it's stable to slightly up unless we get one of those shocks that nobody expects.
Jason?
I'm in the same boat as we're probably neutral, maybe slight increase, spot rate 4 or 5% year over year. Nothing like I was forecasting 6-7 months ago when I was saying 20% up year over year. I don't see that happening.
Yeah, flat year over year. Samantha, shippers still have pricing power. I think they'll have pricing power well into next year, maybe spring of next year, before we see any sort of rate inflection of a meaningful level. I think large carriers are still chasing rates down. They're still trying to hold on to volume by decreasing their rates. They're still trying to find where equilibrium is. I don't think they're even close to that yet. Look, especially reefer and flatbed, new rates coming into routing guides in reefer and flatbed are still single-digit negative, have been for 2 years. So I see excess capacity in reefer, flatbed, large contract carriers. Spot market's a little bit different. I think it'll be flat year over year, largely because of the economics that we sort of covered a bit earlier, that there's a lot of carriers out there now, a much bigger cohort this freight cycle, that are extremely profitable, as in they have very low levels of debt compared to previous cycles.
A question, the last couple of years, it's kind of come into question in several spaces I've seen. Do we really have a peak season anymore in the traditional sense for the full truckload market? I know around the holidays, we see a lot of like e-com space where they definitely have a peak. But with the pull forward of inventory specifically this year, are we really anticipating to see much of a peak for the full truckload market?
Yeah, I don't think so. I think we may have seen peak season, especially on the import side, but I think we'll see strong seasonality rate directionally wise in reefer, flatbed, and dry van. They've already started the July-August slide south this week.
Yeah.
So is there any point after August that things bump back up, or is it basically going to be dependent on maybe we have like another road check week? I think we could have storms disrupting certain parts of the country.
Yeah, break check week end of August. Yep.
November, December tightening. I will say storms get overblown. Former doctoral student of mine has done some research on this. Harvey moved the needle a very little bit, but you got to go back to Katrina to really have a meaningful impact. And we had a devastating storm this last year in Milton and didn't really move the needle. Yeah. So the storms don't really have the impact they're perceived to actually have.
Yeah. It's probably more a drop in the bucket when you think about even market tightening in a very specific geographical region for a very short period of time.
Exactly. Anytime the market's at equilibrium, which I think we all agree it roughly is, you're always going to be more vulnerable to whatever the shock is, whether it's a storm or something else, even if it's short-lived. So I think it's the risk for the market spiking, even if short duration, is much different now than it was 12 to 24 months ago when we were down in the trough.
Definitely.
So it sounds like maybe with the absence of what used to be a traditional peak, we kind of keep an eye on maybe some storms, road check week, break check week, I think, and then tariffs, of course, because each time we've seen a change or an announcement in a tariff, we've seen a little bit of a bump in imports and what that does to move into inventories. But nothing, obviously, that the market at equilibrium hasn't slightly adjusted to and then come back down and handled thus far. So I would be personally shocked to see bumps in imports be significantly larger than what we've already seen. And someone correct me if I'm wrong there.
Probably the opposite in California, right? Where 50% of the imports come from China. Volumes are down 30% year over year. So there's some structural damage to the dray market, warehouse market, 3PL market in the state of California. For a long time, as goes California, so does the rest of the country. Not so anymore, and particularly not so in produce.
Right. But we definitely haven't seen the freight apocalypse air pocket, right? That was,
Right.
certainly reported widely out there for, for a hot minute, when the trade war started.
Right.
Okay. My last question for all of you quickly, and then we have some questions from the audience for anyone who could stay to answer. My last question is just also succinctly advice that you guys would currently give to a broker, a carrier, or a shipper in this market environment.
I'll start. My main advice is to follow everybody here on this panel and the regular content, whether that's Jason's daily post, Chris's monthly report, Dean's weekly show, or Samantha's podcast. I think you're going to get a lot of information there. Flexibility in your network, pay attention to what's going on, know your cost structure, and be smart with decisions. I'll kind of leave it at that.
Yeah, I'd say just to add on, I think the rate relief is coming, right? But it's not coming nearly as fast for a lot of folks that are out there. So I mean, there's been a lot of progress over the last kind of year or two around, automation, taking cost out, doing more with less. So I don't think that stops. So, keep doing what you're doing. I think on the shipper side, don't get complacent. I think you're going to have some optionality and there'll still be a shipper's market for some period of time, but it won't last forever. So if that means investing in other modes or, reallocating, carrier capacity or doing something different in terms of the routing guide, I think you don't get complacent, things will change at some point.
Yeah, ironically, U.S. labor productivity, I believe, decreased in Q1, despite what we hear about AI taking over the world. But I would encourage freight people to not fall into the decrease in productivity. Now is definitely not the time to be not being more efficient with your operations. So please continue to pursue whether it's AI or automation or just any type of general efficiencies within your operation. Jason, I do have a question for you. We had talked before the show, and you had mentioned like a worst case scenario where we don't see any recovery in rates until potentially 2027. But I'd like to get your advice on what you would recommend to people for the next 6 months. But then also, let's assume we don't see a rate recovery, in the next 6 months or even 9 months. What's kind of the advice that you're putting out there?
Yeah, so as everybody's mentioned, so right now, one is you've got to plan for different scenarios. You've got to have a best case, you've got to have a worst case, you've got to have a middle case scenario. So that's number one. And number two, it's finding those efficiencies. If you're a carrier, it's about the economies of scope across hauls, getting deadhead minimized, trying to cement those relationships with key contract shippers to get balanced networks. For brokers, it's playing the game, knowing the market better than your rivals. And for shippers, I hate to say it, but it's kind of just same old, but always remember this market will eventually turn. And if you act opportunistic now, carriers will remember when that time comes to get their revenge.
Dean?
Two things. I think for carriers in particular, slow down, look for new opportunities. This is going to be a matter of saving pennies the rest of the year in terms of economic survival. Speed's one of the biggest things with diesel at around 30 cents or 30% of your operating costs. So that's absolutely critical. Any margins of profitability, I think this year will come through cost reductions. But the more important thing, I think, is work with people like David in particular to build relationships, try new things. Don't be afraid to make mistakes and venture out into territories that you haven't been before, because I see structural change in this industry in terms of how freight's moving. And I don't know that we can rely on past freight patterns to dictate where we think the market's going. At a carrier level, I think you need to have really good partnerships with good people like David to make sure you're in the right place at the right time.
Dean, I might need to have you back for a whole conversation on that, because I've been talking about that lately too, and how things seem to be changing as far as the role of the broker, the role of the mid-sized carrier in our industry, and how technology is changing some things, and in other ways, I think cementing old truths that will always be there. So love to have that conversation. Okay, let me ask you guys a few questions. We'll get some answers out there. I'm going to go back to the beginning here. Chad asked, has recent shrinkflation, that was me, I unhit it. Has recent shrinkflation, packaging changes, or post-COVID inventory management learnings had any impact on the underlying volume of consumer goods shipments?
It's interesting.
One of the things we've heard from some shippers is there's less urgency to get trucks out partially filled, right? Like timing is less urgency. So they're waiting to kind of get trucks filled up. I think inventory management has improved in that regard. So you're seeing less like half full shipments moving, and that's probably affecting volumes, things to that degree. So, that's probably the one note I'd mention.
Yeah,
that's a great tee up for it. I think in the past, shippers haven't had a reliable, mode of transportation to move those full truck, those half truckload shipments without compromising the unit economics. So I think shippers that are doing that, you're still letting inventory kind of sit idle. And so, and I think Dean talked about, trying new things, new modes, new relationships, new methods of operation, new partners. David talked about there's definitely not the same urgency to move underutilized trucks and pay to ship air. I think that's true. I think we go into a market like this, and we still have plenty of shippers that are turning over every rock to cut freight savings, keep freight moving, increase velocity. Plenty of carriers that are out there looking to maximize the revenue yield of those fleets. So I mean, all blends into opportunities to leverage things like shared truckload transportation, which hasn't traditionally been available to address some of those challenges.
Yeah.
Samantha, one of the things we've seen, and I think this partly addresses Chad's question, is we've seen last year the most number of partial shipments ever on our load board. So that's a function of fewer shipments, but also fewer truckload shipments, as a full load, and but a higher growth rate. And that's why we've just added cargo vans, sprinter vans, box trucks, lift gates to our load board as equipment type designation, because it's one of the fastest growing markets, I think. Which I think is what Chad's getting at, is we're seeing fewer full loads, but more partial loads. And I think that's partly the growth in new carrier authorities, is this smart capacity that's moving to where the freight's moving in the quantity that it's moving in.
Sure. And I think we all have to remember, I think it was 2021 to still into 2023 when all the LTL carriers kind of said, yeah, if it's more than 6 skids, we don't want it anymore. So we're just going to make it way too expensive to make sense to move it here. Right. And so that was a lot of people's liftgate options. That was a lot of people's, mid-sized volume options. And the LTL industry basically just said, we're cutting that out. And so it had to go to the FTL industry. Exactly. And so now we've seen an increase in demand for those partial shipments. Excellent call out, guys.
And they don't need CDLs or drug testing.
Well, let me see. That just made me think. We had a question, and also, I think from Dean, that said, with demand being in limbo, Dean mentioned that supply changes are the only major driver impacting price in the next few quarters. How do we think about ELP enforcement or the chilling effect of it as it affects capacity?
Do you want an immigrant to take this question? An immigrant with a CDL. Nothing makes my blood boil more than this subject. The idea that there are still drivers out there after all this is blown up over nothing, mind you. There are still drivers out there who can't speak English. It's like the worst argument I've ever heard. If you were on the road and this blew up in March and you couldn't speak English, I know drivers that headed for the hills. They avoided Arkansas like the plague. And of course, they sought shelter where they could work in a drayage community or somewhere where they weren't exposed to that. So I think my answer to Chad is, I think the effect of ELP, if there was one, has already occurred.
Yes.
The idea we're now going to start enforcing it is another issue. Now, David raised a good point about non-domicile CDLs. We talk a lot about Mexican carriers, but we completely ignore every owner-operator from Canada I know comes in and hauls intra-country freight before they go back across the border. So that could have an impact. But again, I just don't think, A, they've got the enforcement numbers to do it, and B, it'll have any material impact on spot rates, which is...
Oh, I lost Dean. Dang. I'm sure he's going to, there we go. You kind of catch back up. Well, I was just going to say that I can't name names or anything like that, but I had been given the perfect example of a drayage carrier who just hired about 5 Vietnamese drivers who only speak Vietnamese. And they were basically seeking job refuge in the drayage community because, for anyone who doesn't know, in a lot of ports, everything's fully automated. You don't talk or interact with anyone to pick up or return containers. And so I do think, to that point, while I'm not advocating for that being a solution, but I would say that certainly the impact might have already taken effect. They saw that coming. They moved into a different part of the industry where they would still be able to operate without having to.
There's a touch of irony here, Samantha. After 2.5 decades of a driver shortage, supposed, in quotes, we actively sought drivers from other countries. So we actively sought immigrants to solve the driver shortage problem, both here and abroad, and even actively sought incarcerated. And yes, I built predictive models to see which type of crime made the best truck driver in my prior life at Omnitrax Analytics. A whole podcast for another day. But the irony is that we've now had a driver shortage for 2.5 decades. It turns out we've now got the wrong type of drivers. And I went, I did 3,000 miles on my vacation 2 weeks ago to Wisconsin and back for a truck show. And I went through at least 35 truck stops deliberately to sit and listen and talk to truckers. Guess who is working long haul? Immigrant truckers. Not one of them couldn't speak English. Now, English wasn't their first language, but I could understand them. Even with my Australian English, I could still communicate with these guys. So the idea that we have a lot of truckers out there that can't speak English, it just doesn't make sense in reality.
So, I mean, my argument is again, look at an actual regulatory shock, and that was the ELD mandate.
Right.
People predicted the sky would fall, the world would collapse. And you know what? Full ELD enforcement goes into effect in April of 2018. And by Q4 of 2018, the spot market was already cooling. 2019, we have full enforcement. It's a flat market. Full no AOBR grandfather kicks in at the end of 2019. Nothing really happens. And so, again, it's all about demand. At the end of the day, supply can move the needle a little bit. But just as Dean mentioned, this has been turned into like the new boogeyman out there. And, you know, I'm much more worried about the trucks driving 75 miles an hour on I-96 by me than anything else. Because you want to know what causes crashes? Speeding. And that's empirically documented more so than anything else.
Yeah. I think we kind of answered this question. Michael asked, to what degree are the swings and roundabouts of global shipping demand as driven by tariff on, tariff off, impacting the domestic freight markets? And I think we kind of talked about how they created these like small surges in demand and rates, and then it kind of, the market didn't sustain any disruption, it's cooled. I would expect to see the same moving forward. Anybody have additional thoughts on that? Good. Hopefully we got that question for you, Michael.
I would just say welcome, Michael King, all the way from London, I think.
Yeah.
Mike King is from London, correct?
I'm not sure, but I do get analytics on what countries listen in, and I've seen some fun ones. So I'll have to check after this show. Yeah. I think Steve had a great question. He said, in the next 3 to 5 years, what should students of logistics be focusing their energy on to ensure they are able to step into the workforce and be ready to provide immediate impact to driving corporate efficiency?
Be able to do, I mean, you got to know Excel really well. You got to understand data frames. You're going to have to be learning AI tools. Yeah. I mean, that's where the reality is moving. You still also have to be a good team player and communication. But things are moving, certainly academic wise, much more towards the analytics side. My courses I teach, we are in Fred, in Excel, doing forecasts. It's basically almost applied analytics with supply chain as a context. So it's not just you need to understand the supply chain ideas, but you need to be able to work with data.
Yeah. And as someone who studied, I studied operations management, and I actually have a minor in statistics, which is embarrassing because I'm really bad at Excel and statistics. So I'm a fail for Jason's recommendation there. But if you guys are in school, something that I've called out before is that a lot of supply chain and operations degrees focus on going into what we call shipper side of the industry. And so I think it would be really cool and really helpful to try to plug in and find some ways to connect with the actual trucking community, or even like if you have brokers that you could shadow or intern at, just to kind of get a more well-rounded feel for what this other side of the industry looks like from the provider standpoint as well. I think that's something that I recommend. And I feel like I kind of had in a way, because I got to do some work on the shipper side and like understanding that in school. And then after I went into the operations side of a trucking company. And so it was a really cool experience. And I recommend that. The AI thing, man, probably, unfortunately, is also a great call out there, Jason. Yeah. Let's see if we had any other ones that we need to make sure we get to here. Someone did ask if we foresee more small carriers exiting the marketplace by moving in the form of moving to larger fleets. So curious if we've already seen that happen or if it's going to continue.
I think it's happening. I think the hardest part about the supply side is just so little data to understand truly what's happening in terms of active seated capacity. And again, as these cycles ebb and flow, the most vulnerable segment is the smaller carrier. The small carrier that decoupled from the large national when spot market spiked. It was easy to make money. There's now dozens of apps out there to get spot freight, which even kind of reduces the barriers to entry. And when the spot rates tank, the first wave of casualties tend to be the smaller carrier, even the ones with the lower operating cost structures. And so I think the first wave, the longer that the spot market stays deflationary, that's really the small carriers get freight just because they're small enough, because they're battered and they're small, so they can't really support higher volume contract commitments. So they're getting a lot of freight from load boards or from brokers. The longer the spot market stays, painfully deflationary, eventually those seem to be the ones that tap out, either exit or go contract back on, with the large nationals. So I think it's more the ebb and flow of the small carrier that moves the cycle altogether, right, than anything that's happening with even the mid-size or the large nationals. So I believe it's already happening. To what extent, it's really hard to kind of pinpoint with any level of precision.
There's weird employment dynamics out there, because in terms of capacity being subtracted from the industry, it's always the big players downsizing or failing that is by far the biggest driver. But in terms of new capacity being created, it's always the new entrants. And in terms of variation and new entry is really what drives those dynamics. And as was mentioned, there's no evidence yet that new entry is it's not stalled out like it did in 2009, which is still really surprising. And the other thing too is that a ton of new entrants that were even formed in 2021, right, the greatest market year ever, 34% of them are gone in 2 years. And so a ton of firms they get created, they fail. The failure rate's 34% for a carrier. Based on the business dynamic statistics data between founding and year 2. So this is just a perpetual cycle we live in this industry, but that is what it is.
I just did a Google search. Moving to this next question. Are there any thoughts on the effect of defunding NOAA or FEMA on either the upcoming hurricane season or moving into next year? Didn't get super clear answers yet, but it looks like there is funding cuts by states for a lot of FEMA programs coming. And so I personally, coming from a broker carrier background, I know that FEMA has a reputation for they need immediate help, fast trucks in, freight, they pay well. It's a highly profitable account for a lot of brokers, specifically because of the flexibility needed that service that customer, so to speak. So anybody that's all I would say. I don't know that we have hard numbers yet on what's being cut for sure and how much, but anybody have thoughts?
So I'm not a big believer that hurricane season really does much. And so I don't see this in any way significantly.
Yeah,
I think it'll depend on if there's certain providers that are kind of the FEMA core go-to base that rely on that boost in margins each year. So.
FEMA, we've seen less and less move on spot, that sort of last minute rush, because FEMA have set up long-term relationships with providers that jump in. It's not really a spot market play anymore. So we don't see the volatility.
That's good to know.
Yeah.
Let's try not to get too in depth here, but someone asked if the tariffs on imported raw material will affect domestic manufacturing. Will the issue compound, or will the need for manufacturing balance it out?
I mean, we know from a study done from the 2018-2019 tariffs that manufacturers that imported more goods subject to tariffs saw declining exports in 2019. Very clear what we call causal identification. There's no evidence that especially upstream tariffs on things like steel and aluminum and parts generate manufacturing jobs. There's just no empirical evidence of that. And given, Japan and South Korea are, ironically enough, two of those biggest sources of inputs in those various sectors, as well as Malaysia, it's just difficult to get positive about this stuff. And I'll give you a statistic. 2018, in October, Trump administration starts tariffing Chinese furniture. First time we start tariffing furniture. Furniture production in 2019 in the United States falls 6%. And furniture production today in the United States is 25% below 2017 levels. Furniture production ain't coming back. And so that's the challenge with all of this, is this idea that there's going to be massive reshoring. Does anybody here want to go open up a furniture manufacturing plant hoping we keep these tariffs in place on Vietnam, Malaysia, and Indonesia for the foreseeable 20 years that you need to make that factory? Any bank want to fund that? No. That's the problem with policy that is artificial. No one wants to make a long-term capital investment to capitalize on that specific policy. If that change, it's all automatically no longer cost competitive.
Okay, another tariffy question here. I think I might know this one. I've been trying to brush up on this. Since tariffs on 7 new countries kick in August 1st, does that mean that freight has to arrive in the U.S. before August 1st to avoid being tariffed, or has to deport the country of origin before August 1st to avoid tariffs? From my understanding, what matters is when it hits U.S. customs, and that is when you pull it out of a bonded space. So if it's in port, doesn't matter. When you pull it out of port, if you're not taking it to a bonded warehouse, that's when your taxes and duties and everything come due. So that's why we've been talking about bonded warehousing spaces and bonding transport, because we've seen actually there was an article written that there was like a surge in bonded warehouse demand, where people are essentially bringing in their inventory and then letting it sit in bonded warehouses, waiting for the tariffs to reverse if they pulled in at the wrong time, to then pull them out of the bonded space. Because whenever you pull it out of that bonded space is when you're going to pay whatever the current tariff rate is that day. So that's what I've been saying. Correct me if I'm wrong.
Unless there's an on the water provision, but we haven't seen paperwork yet indicating that. And my hunch with this is there's not an on the water provision with these. So basically you got a month to get stuff, not even that, which means at this point you can't move it by water. I mean, you're either on plane or you're going to be eating those tariffs at this point, realistically.
I think we covered that one. Yep. Did we cover FMCSA ELP enforcement?
Yep.
Yeah. Okay. Well, I know I've kept you guys over time. I appreciate it. Thank you so much for being here, gentlemen. This was a great show. For anybody who didn't catch the full thing, you'll be able to listen back to this here on LinkedIn. And then usually within 24 hours, this is going to be available on all major streaming platforms. If you like to listen on Spotify, Apple, anywhere else, it's available immediately on YouTube and here on LinkedIn. If you guys listen back and you have questions, please feel free to come back to the show link on LinkedIn and comment your question and tag the person you'd like to direct it to, or myself, and we'll see if we can add some thoughts in there, keep the conversation going after today. But gentlemen, thank you so much for being here today.
Thanks.
Thank you.
Yes.
All right. And thanks to everyone who listened in. We appreciate you guys meeting us for coffee. Thanks so much for meeting us for coffee. I'm so excited to be partnered with Watco as our show sponsor. Not only was Watco founded in my home state of Kansas, but the solutions they provide are, in my honest opinion, unmatched. If you have questions about Watco, you can scan this QR code to connect, check out the link in the episode description, or you can shoot me a message on LinkedIn directly, and I'm happy to talk more. If you enjoyed today's show, I'd love if you could leave a rating on your platform of choice. We'll see you next time.